You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the Deep Dive. We're here to sift through the noise, pull out the key info, and get you up to speed fast. Today, we're tackling a big one, something lots of you have asked about. Real estate investing. Now, when you hear that, you probably think, buying rental houses, dealing with tenants, fixing things, needing this huge chunk of cash up front. It feels like a lot.
It really can.
But what if that's just scratching the surface? Our mission today is to explore how you can actually build wealth through real estate without buying a house directly. We're talking REITs, crowdfunding, stocks, all sorts of ways.
Yeah.
Some you can start with maybe just $100.
Yeah, the landscape has really changed.
So if traditional real estate seems daunting, or you just want that exposure without the landlord stress, this deep dive is for you. Okay, let's unpack this. First off, why real estate? Why is it always seen as such a cornerstone of investing?
Well, it's historically been incredibly reliable for building wealth.
Right. And the Fed data backs that up, doesn't it? Like 25% of the average American's net worth.
Exactly. And for the wealthiest, it's often much higher, 40% or more sometimes. There's definitely something powerful there.
So what is that power? What makes it tick?
There's a few key things, really. First, it's tangible. It's a physical thing. People like that sense of solidity.
Security.
Yeah, security, control. Second, historically, it appreciates. It tends to beat inflation long term, despite the dips.
Okay.
Third, it generates income rent, dividends, that sort of thing. And fourth, this is a big one, the tax advantages. The system is, frankly, quite friendly to real estate. Depreciation.
Right, where you deduct a value even if it's going up.
Precisely. And 1031 exchanges, which let you defer taxes when you sell and reinvest. It's powerful stuff for building wealth over time.
Okay, those benefits are clear. But here's where it gets interesting. Let's flip to the challenges of that traditional path. Buying the actual property.
Yeah, this is where a lot of people hit a wall.
What are the main hurdles?
Number one is usually capital.
Right.
The down payment needed for an investment property, often 20, maybe 25%.
So on a, say, $300,000 place. That's
$60,000, $75,000, just the down payment.
Wow.
Plus closing costs, repairs, reserves. It adds up fast.
And the time.
Oh, the time commitment is huge. Being a landlord isn't passive income. Not really.
Yeah.
It's active management.
Screening tenants, fixing things.
Collecting rent, dealing with vacancies, legal stuff. It's basically running a small business.
Okay.
Then there's risk concentration. You put a big chunk of your money into one asset, one location. What if that market tanks? Or you get one bad tenant?
Yeah, all your eggs in one basket.
Exactly. And finally, it's illiquid. You can't just snap your fingers and turn a house into cash like you can with stocks.
It definitely sounds like a heavy lift. But the good news, and this is the core of our deep dive, is that these other ways we're exploring, they let you capture those benefits, the appreciation, the income, maybe even tax advantages, the diversification.
Without those big traditional barriers.
Exactly. So where do we start? If someone's thinking, okay, how do I actually do this? What's the first door?
For most people, the most accessible starting point is probably real estate investment trusts, REITs.
REITs. I always think of them as like mutual funds, but for buildings. Is that fair?
That's a great way to put it, yeah. REITs are companies that own, operate, or sometimes finance income-producing real estate. They pool money from lots of investors, buy up properties, could be apartments, malls, offices, warehouses.
Okay.
And the key thing, legally, is they have to pay out at least 90% of their taxable income to shareholders as dividends.
Ah, so that's why they're popular for income seekers.
Absolutely. And there are different flavors. Equity REITs are the most common. They own the properties, collect the rent. Think residential, retail, office, industrial, lots of subcategories.
Okay.
Then you have mortgage REITs or MREITs. They don't own buildings. They deal in mortgages and mortgage-backed securities.
So they're more like the bank side.
Kind of. They make money on the interest spread, but they can be more volatile, very sensitive to interest rate changes.
Right.
And then hybrid REITs mix both strategies.
Got it. So if I want to buy into a REIT, how do I physically do that?
Two main ways. The first, and usually the best for most individuals, is publicly traded REITs.
Like regular stocks.
Exactly. Listed on the big exchanges, buy and sell them through your brokerage account. Super liquid.
Any famous examples?
Sure. American cell towers, Proley Jonitz warehouses, logistics, realty income, They even call themselves the monthly dividend company.
Ah, I've heard of them.
Then there are non-traded REITs, not listed publicly, sold through brokers.
Less liquid, I imagine.
Much less liquid. Often higher fees, too.
Mhm.
They might promise more, but for transparency, liquidity, lower cost, publicly traded is usually the way to go.
Okay, makes sense. Now, a big selling point you hear is diversification. Own a REIT, own a piece of hundreds of properties. But let's push on that. If the whole real estate market takes a nosedive, does that diversification really protect you? Or is it just spreading the pain?
That's a really good question. It absolutely protects you from specific risk. You know, one bad property, one city's downturn that gets diluted across the whole portfolio.
Okay.
Like putting $10 into Vanguard's V&Q ETF gives you a tiny slice of over 180 companies, thousands of properties.
Yeah.
Compare that to $10 down on one condo.
Big difference in diversification.
Huge. But to your point, REITs are still tied to the market. If there's a major crash like 2008, or if interest rates spike dramatically,
We'll feel it.
they will feel it. Their prices can drop, especially because rising rates make their dividends look less attractive compared to safer bonds.
So diversification helps with specific risk, but not systemic market risk or interest rate risk.
Precisely. It mitigates, it doesn't eliminate those broader risks.
Okay. So REITs give broad exposure. But what if I want something a bit more specific, like I want to invest in that apartment building going up or that renovation project, but I don't have $500,000?
Now you're talking about real estate crowdfunding.
Right. These platforms seem to be everywhere now.
They've absolutely they exploded, yeah. Regulatory changes open the door. Essentially, these platforms pool money from many investors for specific real estate deals. It's like a modern syndicate.
Okay.
Any big names people might recognize?
Sure. Fundrise is very popular, especially for beginners. Low minimums, like $500 sometimes. They offer these REITs or e-funds. Yield Street was broader, includes other alternatives, sometimes more for higher net worth folks. Realty Mogul has its own REIT-like product and individual deals. CrowdStreet focuses on commercial real estate, often institutional grade stuff.
So it really lowers that barrier to entry, doesn't it? From needing hundreds of thousands to maybe just hundreds.
It's a total game changer in terms of access, absolutely democratizing.
And what kinds of deals do you find on these platforms?
You find a mix. Equity investments, you own a piece, share in the profits and losses. Debt investments, you're lending money, get interest payments, usually less risky but less upside.
Preferred equities kind of in the middle. And then development projects, new builds, big rehabs, higher potential return but definitely higher risk, delays, cost overruns.
Right, more moving parts.
Definitely. The plus side is usually transparency. You often get a lot of detail on each specific deal.
But what are the catches? There have to be some downsides.
Oh, for sure. This raises an important question. How do you navigate this?
Yeah.
A key thing is many platforms, or at least many deals on platforms, are for accredited investors only.
Meaning you need a certain income or net worth.
Exactly. Usually $200K income or $1 million net worth, excluding your house. It's meant as a protection. Though some, like Fundrise, have offerings for non-accredited investors too.
Okay.
Due diligence is critical here, maybe even more so than with public markets, because there's less regulatory oversight.
Got it. Do your homework.
Absolutely. And the big one, illiquidity. Your money is often locked up for several years, 5, 7, sometimes 10 years. So it's not the cash you might need tomorrow.
Right. Definitely a long-term play. Okay. So we have broad REITs, specific crowdfunding deals. What else? Is there a way to get real estate exposure using just the regular stock market?
Yes, absolutely. This is another excellent route, using real estate-focused stocks and ETFs. It blends stock market liquidity with real estate benefits.
Let's start with the ETFs then.
Okay, real estate ETFs are great for instant diversification. They hold a basket of related stocks. We mentioned V&Q, the Vanguard one. Super popular, very low cost, covers the U.S. market broadly. For global exposure, there's REIT, the iShares Global REIT ETF. Good for diversification because world markets don't always move together.
Good point.
SEH from Schwab is another solid low-cost U.S. option. And you can find specialized ETFs too, focusing just on residential or industrial or whatever sector you like.
And beyond the ETFs that hold REITs, can you invest in individual companies related to real estate?
Definitely. You can go beyond just REITs. Think about home builders, D.R. Horton, Lennar, Pulte Group. Their fortunes rise and fall with the housing market. Or real estate services firms like CBRE or JLL. They do commercial brokerage, management. They benefit when the market is active.
Okay.
And then there's real estate tech. Zillow, Redfin. They're changing how we buy and sell. More volatile, perhaps, but tied to the industry's future.
And you mentioned something earlier, this idea of investing in companies that own a ton of real estate, even if that's not their main business. That sounds intriguing.
Yes, this is where it gets really interesting thinking outside the box. Look at McDonald's. People joke it's a real estate company that sells burgers.
Because they own the land under the franchises.
A huge amount of it, yes. And they collect rent. It's a massive part of their profit engine.
Wow.
Starbucks does it too, strategically buying prime corners. Walmart owns the land for many of its supercenters.
So you get the operating business plus the underlying real estate appreciating.
Exactly, the powerful combination. Now, the real estate part might be smaller relative to the main business, but it's absolutely there, contributing value and stability.
That's a really smart angle. It's about looking at the balance sheet, not just the storefront.
Precisely. Digging into the assets.
Mm.
And whether you're using REIT ETFs, individual REITs, home builder stocks, or these hidden real estate plays, the key always is diversification.
Don't put all your eggs in one sector or one company.
Right. Spread it out geographically, by property type, by company type. It's your best defense against any one part of the market having a bad run.
Okay, the landscape is clearly evolving. We've covered REITs, crowdfunding, stocks. Are there other, maybe newer or less common ways to get involved? What's emerging?
Well, there are real estate mutual funds, similar to ETFs but actively managed. Think Fidelity or T. Rowe Price real estate funds. Potentially better returns if the manager is good, but usually higher fees.
Active versus passive.
Exactly. Then there's real estate private equity, traditionally for big institutions, but becoming slightly more accessible. Pooling money for bigger acquire, improve, sell projects. High potential returns, but very illiquid. High minimums usually.
More exclusive.
Generally, yes. Real estate debt investing is another angle, lending money secured by property, earning interest.
Yep.
Platforms like Peer Street were known for this, though that space has seen some shakeups.
Okay.
And looking further out, blockchain and real estate tokens. It's still early days, very experimental.
Tokenizing buildings,
Right.
fractional ownership.
That's the idea. Could revolutionize liquidity and access down the road, but we're not quite there yet.
Interesting.
Don't forget simple international exposure through ETFs and funds, great for diversification, and sector-specific plays focusing on hot areas like data centers, cell towers, healthcare facilities, self-storage, industrial warehouses, driven by big trends.
That's a lot to consider. But you mentioned something earlier, a way to really boost the returns from some of these. Here's where it gets really interesting.
Yes, the tax angle, using tax-advantaged accounts, your IRA, your 401k.
For REITs and ETFs.
Absolutely.
Yeah.
Especially for REITs, because those high dividends they pay out. Normally taxed as ordinary income, which can be a high rate.
Oh.
But if you hold them in a traditional IRA or 401k, that income grows tax-deferred. You only pay tax when you withdraw in retirement.
Okay.
Even better, in a Roth IRA or Roth 401k, it grows completely tax-free. Those dividends, the capital gains, zero tax on withdrawal and retirement. It makes a huge difference over decades.
That's a massive advantage. What about managing volatility?
Dollar cost averaging works beautifully here. Just invest a set amount regularly, say $500 a month into that real estate ETF.
Instead of trying to time the market lows.
Exactly. You buy more shares when prices are down, fewer when they're up. It smooths out the ride and often lowers your average cost over time. Takes the emotion out of it.
Okay, we've mapped out this whole universe of options, REITs, crowdfunding, stocks, tax advantages. How does someone listening actually put this together? How do you build your own real estate blueprint from all this?
Right. It's about making it personal. I'd suggest a 6-step process. Step 1, define your goals and risk tolerance. What are you investing for? Income, growth, both. How much volatility can you stomach? What's your timeline? Are you young with decades to go or closer to needing the money?
Makes sense. Start with why.
Exactly. Step 2, determine your allocation. How much of your total investment portfolio should be in real estate? Advisors often say maybe 5 to 20%. And remember, if you own your home, that's already significant real estate exposure.
Good point. Factor that in.
Step 3, choose your vehicles. Match the tools, REITs, crowdfunding, stocks to those goals and risk levels you defined. Broad ETF for a beginner. High dividend REIT for income. Development deal for aggressive growth.
Tailor the tools to the job.
Step 4, diversify. We keep saying it, but it's crucial. Across regions, property types, public versus private markets, maybe even different platforms or managers.
Don't concentrate too much.
Step 5, think taxes. Where should you hold what? Maybe put those high dividend REITs in your IRA Roth and growth stocks in a taxable account for potentially lower capital gains rates later.
Strategic placement.
And step 6, monitor and rebalance. Check in periodically, maybe once a year. Has your allocation drifted way off target? Adjust back as needed. It's not set and forget.
Okay, that's a clear framework. Let's try a quick example. So what does this all mean for, say, Sarah? She's 35, makes $75K, has $100K invested, and wants 15% in real estate. How could she build that $15,000 slice?
Okay, so 15T target, she could put maybe $5,000, that's 5% of her total portfolio, into V&Q for that broad U.S. exposure, low cost.
Okay, core holding.
Then maybe $3,000, 3% into REIT for some international diversification.
It's smart global reach.
Add $2,000,
Yeah.
2% into realty income for that steady monthly dividend stream.
Income component, check.
And the remaining $5,000, 5%. She could split that across maybe 2 or 3 different deals on Fundrise, getting that private market exposure and potentially higher growth.
Wow. So with 15K, she's got public, private, U.S., international, income growth. That's really diversified without buying a single property.
Exactly. That's the power of these approaches. And to make it work, avoid the common pitfalls.
Like what?
Over-concentration, putting too much in one thing. Chasing super high yields without understanding the risk behind them. Ignoring fees they can eat into returns. Not thinking about liquidity needing cash that's locked up.
Yeah.
And failing to rebalance.
Got it. Avoid those traps. Now, we've painted a pretty positive picture, lots of advantages, but investing always has risks. What are the key ones to keep in mind here?
Absolutely crucial to be aware of the downsides. First, market risk. Real estate isn't immune to downturns. Economic recessions, interest rate hikes, supply-demand imbalances, values can fall. Think 2008.
Right, it's not always up.
Then specifically, interest rate risk. We touch on this. REITs especially can get hit when rates rise, as their dividends become less appealing relative to safer bonds.
Makes bonds look better.
Yeah. Liquidity risk is another big one. Varies wildly. Public REITs, very liquid. Crowdfunding, private equity. Often very illiquid, could be locked up for years. You need to know that going in.
Match liquidity to your needs.
Definitely. Management risk, if you're in an actively managed fund or a specific deal, poor decisions by the managers can hurt you. Concentration risk, we covered that, focusing too much on one area.
Okay.
Inflation risk, sometimes real estate hedges inflation, sometimes high unexpected inflation can hurt, especially debt investments. Platform risk for crowdfunding. Is the platform itself stable? Will it be around in 5 years? And regulatory risk changes in tax laws, zoning, securities rules can always impact things.
That's a healthy list of cautions. How do you manage these?
The best strategies are consistent. Diversify broadly. Don't invest money you might need soon in illiquid assets. Do your homework on platforms and sponsors. Keep an emergency fund separate. And review and rebalance regularly. It's about managing, not eliminating risk entirely.
That makes sense. Okay, this has been incredibly insightful. Let's bring it home. For someone listening right now, fired up and ready to start, what are the concrete first steps?
Bring it down by starting capital. If you're an absolute beginner, maybe have under $1,000.
Yeah, just getting started.
Open a low-cost brokerage account. Fidelity, Schwab, Vanguard, plenty of good options. Start with one broad, cheap real estate ETF like VNQ or SCHH. Set up automatic monthly investments, even if it's just $50 or $100, and reinvest those dividends. Let compounding begin.
Simple, effective start. What about intermediate, say $1,000 to $10,000?
Now you can diversify more. Maybe add a second ETF, perhaps an international one like REIT. You could consider buying a few shares of individual well-established REITs you've researched. And this is where exploring a platform like Fundrise makes sense, dipping a toe into private markets.
Building out the portfolio. And for more advanced investors, over $10.
Here, you can build a really robust, diversified portfolio. If you're accredited, you can explore platforms like CrowdStreet for potentially higher return commercial deals, maybe look into private equity if you have the capital and risk tolerance, and really focus on tax optimization, putting the right assets in the right accounts.
Tailoring the approach. Okay, let's make it super actionable. What can someone do this week?
All right, action steps for this week. 1, look at your current investments. Decide on your target real estate percentage. 2, research 2 or 3 specific options ETFs, REITs, platforms that fit your goals. 3, open the necessary accounts if you don't have them. 4, big one, make your first investment, even small. Break the inertia. 5, set up that regular investment plan and figure out how you'll monitor things.
Love it. Actionable steps. Where can people go to keep learning?
Oh, tons of resources. Read the prospectuses for funds in REITs, dry but important. Follow reputable financial news sources for market updates. Books like The Intelligent REIT Investor by Brad Thomas are classics. Online forums and communities can be great for discussion. And seriously, consider talking to a fee-only financial advisor for personalized advice.
Great resources. So the big takeaway here seems to be that real estate investing is way more accessible than many people think. You don't need to be a landlord. You don't need a fortune to start.
Not at all.
REITs, crowdfunding, stocks. These tools open the door. The key is just starting, being consistent, and letting it grow.
Absolutely. Remember, it's a marathon, not a sprint. Focus on diversification, do your research, stay consistent, reinvest. Let compound growth do its magic over the long haul. Real estate has built tremendous wealth, and these methods make it available to almost everyone now. It's not just for millionaires anymore.
We've talked a lot about owning pieces of the market without owning the actual house. It lets us participate in the growth of properties maybe miles away, places we'll never even see. How does this shift, this democratization of access, change our fundamental relationship with tangible assets? What does it really mean for the future of investment and maybe even our idea of ownership itself? Something to think about.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.